Hey, good morning, everybody. Welcome to another daily market report brought to you by Mike Bjork. Today is Wednesday, Hump Day, so I hope all you guys are ready for upcoming weekend. So we're already halfway through, and it's August 17th. So let's go ahead and take a look at the economic news releases we got scheduled for today, and that will begin with the PPI report. And what that is, it's well, producer sorry, it says producer pride index. My bad. It should be producer price index, which is the wholesale gauge for inflation. So back in June we had a negative 0.4%. 0.4%. We figured it would go up a little bit to 0.1%, and it went up to 0.2%. So pretty close to estimations, a little bit higher. Now if we take the core, which we strip out food and energy, which is the better gauge for things because of volatility of those two factors. Back in June, we had 0.3%, and we figured it would drop a little bit down to 0.2% for July, and it actually jumped upwards to 0.4%. So that's a little bit concerning on that level, especially when food and energy has been kind of dropping a little bit. But I don't know. You look at gas, and gas price, like I said earlier in the week, was about $80 a gallon, but I haven't noticed much difference at the gas pump. So I don't know about you. Maybe it's different here in Southern California, but I haven't noticed a big difference, and maybe the oil guys are taking their profits. So let's go ahead and look off to the headline news. And of course, tomorrow, one of the things we have to look for is the CPI. That's going to be an important gauge. The PPI isn't a huge factor because the wholesalers don't always pass that on to the consumers. So that's why, but it is something to keep an eye on. But tomorrow's report with the CPI will be a bigger factor as to where inflation will be. So, headline news, of course, the stock market's up a little bit. It was actually on triple digits, and it's actually been closing, losing a lot of steam. It was in triple digits, and last I looked, it was actually about 6. So it lost a lot of steam from being over 100 earlier. A lot of it had to do with retailers were posting favorable earnings, so they were kind of shrugging out the PPI report, and we're kind of getting excited about the retailers. And a lot of it, I think, shrugging now is a lot of it due to still concerned about Europe and stuff. And another item to note, Hong Kong, I guess they're doing some ETFs to create more mainland China. A lot of it has to do with the investments in mainland China. They're getting about, around 3.5 to 4%, but in Hong Kong it's practically zero. So they're creating a more of a currency exchange in Hong Kong to equal that of mainland China. So that way, more investors from mainland can invest in Hong Kong and create more of a central uh, base for trading and stuff, which will, of course, that could lead to a raise in value of the yuan, and that in turn, of course, would be more expensive items being shipped from China to other countries as the yuan is stronger, and therefore their cost of goods will be a little bit more expensive. So something to kind of watch there, obviously, since we do draw a lot of product from China, that obviously our costs will go up, and that could raise inflation here. I'm hearing a lot of talk, around here, Southern California, that people are looking at maybe just trying to buy American, so provide more jobs. So something to watch out for if you're American in the U.S. here, and if you could see something comparable and within a few bucks, why not try to salvage a few more jobs here? So not to try to be privatization or nationalization, but we are a global economy, but why not? So let's take a look here at the bond market, what the interest rates are doing. As the stock market's been decreasing a bit, bond market's actually is going into bonds as a safety, and it's actually improving us. So we're actually a little bit better today. Rates will be the same, if not a little bit better than what we received yesterday. So interest rates are better today, as interest rates are, as the bond market's going upwards a little bit. And kind of sitting, as we can see, kind of it's been going this sideways pattern here, but it's gone up a little bit here. So as bond market goes up, interest rates come down. So this is obviously good for those who are looking to buy homes or looking to refinance. But I wouldn't sit still. I would, if you're looking to refinance, I would jump in now. It's important. So as this could quickly change, and we are due probably for a correction anytime soon. So we don't know when that could happen, and you could lose out with what's out there. So anyways, if you're looking to do any home buying or if you're looking to refinance, want to get some more information, some free reports, go ahead and check out my website at californiamortgagetips.com. You guys have a wonderful day, and I'll catch you tomorrow.